Welcome to Investors Insights. Our topic today is cautiously optimistic. Here we are in the month of September 25th. It's hard to believe that in 90 days, we will experience Christmas Day. Think about that. The year's moving fast and a lot is going on between now and as we enter the end of the 2023 year. It's also historic in that today is Ty Miller's 29th birthday. And in honor of his birthday, I'm here with my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. And cautiously optimistic is something we want to talk about as we see market volatility, all the headlines that people are dealing with, government shutdown, strike here, strike there. But Ty, you brought to the table some good information here, which I greatly appreciate. And on your birthday, sir, please share that wisdom with us.
All right. I'm not used to leading off, but I have a chart here talking about pre-election years, and then it's comparing 2023. And so a saying that I always like is, history doesn't have to repeat itself, but it does usually rhyme. 2023, which is, of course, a pre-election year, and then every pre-election year average line up to be so, symmetrical here. We obviously had a big difference in March because of the bank failures. The government kind of stepped in and helped handle that so it didn't expand. But now we're in this time where the trend is just kind of flatline, a little bit up, a little bit down, and it kind of stays that way historically, kind of through November before we kind of get a Santa Claus rally near the end of November into December. Again, this doesn't have to happen. History doesn't have to repeat itself. But I do find it always interesting when you see something like this and just kind of, how the market moves, in trends.
Yeah. And so pre-election year, historically Santa Claus rally. Is that what you're saying there, Ty?
Yes. Yeah. Typically strong through April and May and June, and then kind of flatline, and then Santa Claus rally. Correct.
Yeah. So folks, as I said, in 90 days, we're looking at Christmas Day, and we'll just see what takes place if history does repeat itself. But one thing is definitely certain. We're seeing a lot of activity in interest rates and economies throughout the globe. And Bobby, you brought up about cautiously optimistic as well. It'd be great to have a Santa Claus rally this year, but also cautiously optimistic in compared to the rest of the economies out there. Talk about that.
Yeah, so last week we talked about how a government shutdown that's looking likely to happen October 1st usually doesn't lead to a long-term downtrend in stocks. And we had a client ask us last week about adding more exposure to the Eurozone stocks when the U.S. is in the middle of a shutdown. So I want to talk about our conversation real quick. So while we're big believers in diversification across asset classes, sectors, different markets, I want to show two charts of why we remain overweight to U.S. markets, underweight Eurozone markets. So the first chart I want to discuss shows the Global Purchasing Managers Composite Index. So first, what is that? Obviously, the Purchasing Managers Index is an index that shows the direction of economic trends in the manufacturing and service sectors. It basically summarizes where the market conditions are expanding, staying the same, or contracting as viewed by purchasing managers. And the purpose of the index is to provide information about current and future business conditions. So basically, if you look at this chart here, a reading above 50 represents an expansion, and a reading under 50 represents a contraction. It's an index we follow pretty closely here. You can see in this chart on the far right column that the current PMI of the Eurozone is 46.7, which reveals contraction, while the current reading of the U.S. PMI is 50.2, which means expansion. The second chart I want to show shows earnings estimates trending up for the S&P 500, seen in the dark blue line at the bottom, and the earnings estimates trending down for the European index, seen at the top in the light blue line. Obviously, corporate earnings are a key driver of markets, and it's clear that estimates are looking better in the U.S. compared to the European index. So in summary, we are allocated heavily towards U.S. markets, even with the threat of a government shutdown, based on the fact that the U.S. economy and corporate earnings estimates are trending better in the U.S. than in the Eurozone.
Yeah, no, I thought that was great insight looking at it from a global perspective and going with that theme of cautiously optimistic. Trey, you brought up some great points tied to Bobby's information about the Fed and what's happening here in this past week in the U.S. in comparison to other economies. Talk about that.
Yeah, thanks, Greg. Correct. The markets really reacted negatively to what the Fed gave us on Wednesday of last week. And the question is kind of why? Why did the markets react so negatively? The Fed did exactly what we expected them to do when we talked on Monday's vlog of not taking any action. The Fed left rates exactly where they are. But then the market quickly fell off 2.8% to close the week. Now, why is that? That's likely due to what the Fed said they were going to do going forward. The Federal Reserve, at each one of their meetings, they project out where they expect the Fed funds rate. Now, that's the rate that the Fed directly controls. So this isn't what they think the 10-year is going to be, or mortgage rates or GDP. This is what they expect the federal funds rate to be next year and the following few years. Now, in their July meeting, they expected the average Fed funds rate to be 4.6% in 2024. In this meeting, they increased that up to 5.1%. That's effectively saying 2 more rate hikes on average between where we are today and where everyone expected us to be over 2024. That is a huge tightening without having to do a single thing. And the market immediately reacted with higher interest rates and lower stocks. Now, looking at more globally, the ECB, they didn't imply higher rates. They actually rose rates again, even though their economy is weakening at this point. The European Central Bank hiked interest rates 25 basis points. And then this week, the Bank of England is expected to hike interest rates by another 25 basis points as well. So our Fed is projecting strength, while the European Central Bank and Bank of England are having to actually continue to hike rates, even though their economies are slowing. So something concerning the international markets seem to be weakening, and the U.S. seems to be holding up. Maybe the cleanest house on a bad street at this point. But I think Thomas Sowell once said that there are no absolutes in economics. Everything's relative. So there's no absolute good here. But relatively, I think the U.S. definitely looks much, much stronger with our Fed being able to pause and project strength, with the global central banks having to still actively try and weaken their economy. Something we're watching very closely, but the markets are definitely watching with a major dip to close the week last week.
Yeah, and that's why, folks, we chose cautiously optimistic. We can see positives, but we're watching it very closely, and we'll continue throughout the remainder of this year. Tying it all to your financial blueprint, your financial house, your portfolio strategies. And we'll keep you updated also on YouTube and our podcast and LinkedIn, Facebook, Twitter. We want to communicate with you in multiple ways, high tech, high touch. Go back and watch our past couple of vlogs, and you will see a consistent theme on what we're reporting. Trey, Bobby, fantastic reports. Ty, you did outstanding. Number one. And let me say this too, happy birthday, sir. We hope everybody has a great week as we continue to celebrate Ty's birthday throughout the week, and we will be in touch. Take care.